Hi, thanks for tuning in. This is Daniel with Value Investing with Daniel. In this video, we're going to be in lesson 2 of our value investing course. So thanks for tuning in. The first video, if you didn't see it, was the course outline where we went over what we're going to be covering. In this video, this is lesson 2, we're going to be going over what modern value investing is. Wonderful companies at good prices. So that is my personal definition of what modern value investing is. So what we're going to be looking for in this course, and really what we're looking for in modern value investing as I define it, is buying wonderful companies at good prices. So let's take a step back for a second and go over a little bit of history of modern value investing, or value investing in general. Value investing was really founded by Benjamin Graham. Benjamin Graham was an investor. He was the teacher of Warren Buffett, and he taught at the Columbia School of Business and ran his own fund. He didn't call it value investing. He just called it investing, basically. In the modern day, people attribute Benjamin Graham's style of investing. They call it value investing, but according to Benjamin Graham, it was just simply investing. We call it value investing to differentiate ourselves from other forms of investors. But the name is partially redundant because what we're trying to do ultimately is maximize our returns. If there was another sort of philosophy that I believed would give me as an investor a better return, meaning would allow me to make more money, I would follow that method. But there's not. This is the best way for most people to invest their money and to grow it the fastest. It beats all other forms of investment, and we're going to be going over it together in this course, and we're going to be summarizing what ultimately modern value investing is. So, as I said, modern value investing is buying wonderful companies at good prices. So, we are trying to buy wonderful companies at good prices. So this has two components. The first component is wonderful company. The second component is good price. These are two different things. We need to define them. Let's talk first about a wonderful company. What is it? So what's a wonderful company? A wonderful company is a company that is able to grow substantially over the next 10, 20, 30 years, meaning it has a lot of room for growth. So it's not at the end of its life cycle, it's at the beginning of its life cycle. And does not require large amounts of debt, if any, ideally no debt. It doesn't require any sort of spectacular innovation, and it doesn't require a lot of capital investment. Meaning the company is almost able to grow more and more and more without really requiring a whole bunch of investment, either taking money from debt or taking money or reinvesting money back into its own business at a large level. But if it chooses to reinvest the money back into the business, it's able to reinvest that money at a very high rate. So let's cover just a couple of these points, and let's sort of write it down so that way we can see what we mean by a wonderful company. So this wonderful company makes a lot of cash, free cash flow, does not require lots of debt, does not require high levels of investment in capital assets. And it does not require lots of R&D. So what does this mean? So a wonderful company makes a lot of cash, lots of free cash flow, high levels of free cash flow, great profit margins, and so forth, okay? It does not require a lot of debt, meaning if we were to look at the balance sheet, we would see that the company does not require debt. It does not require a lot of it. If it has debt, it has a little bit, but it could pay off its debt with all its cash, or it could pay off its debt within 1 or 2 years of all its free cash flow, using its free cash flow. Meaning it does not require a lot of debt. A wonderful company, which is what we're looking for, makes a lot of cash, and it does not require a lot of debt. Additionally, it does not require high levels of investment in capital assets, meaning it doesn't need to, it's making money, it doesn't need to then put that money to repair its equipment at the end of the year. You understand what I'm saying? So you can have a company that's making a lot of money, but at the end of the year, you got to buy new equipment. You got to refurbish your plants. You got to do all this stuff. That's not what we're looking for. I'll give you an example of the airline business. The airline business does not make a lot of money. Why? Because they got to keep on buying new planes. They got to keep on fixing their engines. They got to be doing all this stuff. Instead of that money building up and accumulating and being reinvested in the form of growth, you're reinvesting that money into the business only to maintain your assets. That's not what we want. That's not a wonderful business. A wonderful business makes a lot of money, remember. That does not require debt to make. And when you have that money, you can reinvest it in things that grow your business rather than reinvesting it into things like capital assets, like I say, properties, plants, and equipment that ultimately, once you make more money using those properties, plants, and equipment, you got to put it back into the business to fix those properties and plants and equipment at the end of the year. That's not the sort of business we're looking for. We're looking for businesses, like I say, make a lot of cash, a lot of free cash flow, does not require a lot of debt, does not require those reinvestments to fix its equipment at the end of the year, and does not require a lot of research and development. Why? When companies require a lot of research and development, meaning let's say more than 10% of the revenues they got to pour back into research and development, it means that they got to always stay at the cutting edge of the technology. If they slip up, they could be screwed. So we're trying to avoid companies that do not require a lot of R&D. Like a little bit of R&D is okay, obviously, and a lot of companies do have to do some sort of research and development, but we're not looking for companies that they always have to be on the cutting edge of the technology, and if they slip up once, they're screwed. So keep in mind, we're trying to define here what a wonderful company is. And this is, not only my definition, obviously, this is also like Warren Buffett's definition and other modern value investors as well. So keep in mind, modern value investing is buying wonderful companies at good prices. Wonderful companies at good prices. We got to define what the wonderful company is. The wonderful company is, it makes a lot of cash, does not require a lot of debt, does not require high levels of investment in capital assets, and does not require a lot of R&D. Additionally, there's also a lot of other points for wonderful companies. One is has a strong brand image. Strong brand image. Why? Because then people will keep on coming back, keep on, buying their products and so forth. I'll give you an example of a wonderful company. Starbucks. Starbucks is a wonderful company. So let's have an example. Starbucks. That's our first example that we're going to be covering. Starbucks is a wonderful company. Why? Let's go point by point. It makes a lot of cash. It has high levels of free cash flow. Check. It does not require a lot of debt. If you look up Starbucks' debt, they're able to pay off all their debt with about 2.5 years worth of their earnings before interest and taxes. It does not require high levels of investment in capital assets. Starbucks, as far as I know, they don't have huge capital assets. They don't have huge properties, plants, and equipment. They make coffee. They don't require lots of research and development. What's there to research? What's there to develop? I mean, they make coffee, right? And they have a strong brand image, obviously. So Starbucks would pass all these points, meaning they would be considered, in my mind, a wonderful company. In addition to these points, there's a couple of financial metrics that we need to be aware of that help us identify what these companies are. Obviously, if we're looking at these first 2 points, make a lot of cash, free cash flow, what does that mean? That means every single year they generate lots of free cash flow. And if you look at the general trend, the levels of those free cash flows should be going up, meaning they should be growing. If you look at it 10 years ago, you look at it now, the free cash flow you should see is going up and up and up. It does not require a lot of debt. Let's say in terms of debt, we take the debt, we subtract the cash, whatever's left over, the company should be able to pay it off with at least, within at most 3 years of its average sustainable level of earnings. So what does this mean? Let's go down here. I'll type it out for you. Not a lot of debt means that if we were to take the debt and subtract the cash that the company has in reserve from it, it will give us X amount, which is considered its net debt. The company should be able to pay off this net debt within 3 years of its current sustainable earnings. Its current sustainable earnings equal the average of the last 5 years worth of earnings. So let's look at a company, let's call it company Y. Okay, company Y has $40 million worth of debt, $20 million worth of cash, or let's say $10 million worth of cash. That means their net debt position is 30 million net debt, right? And if we average out their their free cash flow, let's say 5-year average, we would want this 5-year average to be 10 million or greater. So we want them to be able to pay off this $30 million worth of net debt within less than 3 years, basically. And if they're making $10 million a year or greater in their average last year, 5 years, average 5-year free cash flow, they'll be able to pay it off. So that's what we're looking for, not a lot of debt. Like I said, does not require lots of R&D. Let's say less than 10% of revenues goes into R&D, and does not require high levels of investment in capital assets like properties, plants, and equipment. Strong brand image, you'll be able to determine that for yourself. If you recognize the image and you determine it's sufficiently strong, then I think like something like Starbucks or McDonald's, those are companies with good, strong brand images, Google, Apple, etc. And it could be a local image as well, local brand that people locally are familiar with. That would also be an example of a wonderful company. Good price. This is the tricky part, determining what a good price for a company is. I mean, ultimately, it's not overly complicated, but I'm going to try and really simplify it, for you. Basically, if you were to take the free cash flow of a company, meaning the amount of money that's able to be distributed to the owners of the company after the year is complete, and we were divided by the enterprise value of the company. The enterprise value being the market cap plus the debt minus the cash. So if we take the free cash flow and divide it by the enterprise value, we would get the free cash flow yield on enterprise value. Let's break this down for a minute. We take the free cash flow, which is which is at the end of the year, basically the amount of money that the company has that would be able to distribute to its owners, hypothetically speaking, if it chose to, in the form of a dividend, that it could possibly distribute. So this cash is free. It's not being used to reinvest back into the business unless the company wants to reinvest it. It doesn't need to maintain its current position. We divide this by the enterprise value being the market cap plus the debt minus the cash. For those that don't know, the market cap is basically the share price, so the price per share times the total shares. So I'll give you an example. Like let's say a company was selling for $7 a share and they had 1 million shares outstanding, the market cap would be 7 million. If that company also had $1 million in debt, we would add 1 million. And if they had $200,000 in cash, we would subtract the $200,000 in cash. This would now give us our enterprise value. So to conclude this lesson, which is lesson 2, what modern value investing is. Modern value investing is essentially buying wonderful companies at good prices. A wonderful company is a company that makes a lot of cash in the form of free cash flow, does not require a lot of debt, does not require high levels of investment in its capital assets, does not require a lot of research and development, and has a strong brand image. There's some additional points, obviously, to what define a wonderful company also. Warren Buffett famously calls it a moat, which is basically its competitive advantage. So wonderful companies will have a moat, which basically means it has some sort of competitive advantage, some advantage compared to its competitors that allows it to increase its earnings year after year, increase its free cash flow, and increase its revenues, and continue to eat up market share from its competitors over time. We want these companies at good prices being basically the free cash flow yield representing a value to us that's higher than twice the AAA bond yield at a minimum. So if you look at the AAA bond yield, let's say currently it's yielding something like 4.5%. What we're looking for as value investors is at least a 9% yield from the company. What's this 9% yield? This 9% yield is basically this formula here, the free cash flow divided by the enterprise value. So if we had, let's say, a free cash flow, hypothetically, of a company, let's say a company was making $30 million a year in free cash flow, and its enterprise value was something like 247 million, then this would give us a yield here. So let's divide 30 divided by 247. That would give us a free cash flow yield of 12%. You see? And we're looking for a free cash flow yield of at least twice the AAA bond rate. So if the AAA bond yield is yielding, let's say, 4.5%, we're looking for double that, so at least 9%. So that is a simple way that you can sort of evaluate if companies are expensive. As a whole, we're looking for them to be yielding a rate that's at least twice the AAA bond rate, generally speaking. Obviously, there's more complexity in valuation that we'll be discussing, but as sort of a primer, we're looking for companies that are yielding in terms of free cash flow over their enterprise value at least twice the AAA bond rate. So let's sort of go over everything one more time. We're looking for, in modern value investing, wonderful companies at good prices. A wonderful company makes a lot of cash, does not require lots of debt, does not require high levels of investment in capital assets, does not require lots of research and development, has a strong brand image, and has a moat surrounding it. And we'll go more into detail in future videos of ways of finding these numbers. We define some of the terms that we're essentially using here, like not a lot of debt, what it means. We discuss what a fair price is, which generally speaking is the free cash flow yield divided by the enterprise value. We're looking for at least twice the AAA bond yield at a minimum. And I give you the example of how to calculate what the enterprise value is and how to determine what the free cash flow on the enterprise value yield is. So I hope you found this video informative. This is obviously the conclusion of the second lesson, the first one being the course outline, this one discussing just as a general overview what modern value investing is, and we'll be going into more detail in future videos. So I hope you found this video informative. Please like. If you have any questions, please ask them in the comments and be sure to subscribe. Thanks.